Hello, I'm Matt Pierce, Vice President and Senior Portfolio Manager at TrustBank Wealth Management. Welcome to this installment of Chart of the Month. History is full of periods where markets surge in anticipation of a transformative technology, only to stumble when expectations outpace reality. The challenge is rarely whether the innovation is real, but how quickly it can be translated into sustainable profits. With today's excitement around artificial intelligence and the scale of investment from major technology companies, many investors cannot help but draw comparisons to the dot-com bubble and wonder whether this cycle will follow a similar path. So the natural question is this time different? Comparisons to the dot-com bubble are understandable. We're seeing strong market returns, heavy investment, and a lot of excitement around a transformative technology. However, when you look deeper, there are three important differences we will highlight today. First is profitability. Back in the late 1990s, many of the most valuable companies were still early stage. Revenues were growing, but profits were limited and cash flows were uncertain. Investors were betting on what those businesses might become. Today, that is not the case. The companies driving investment in artificial intelligence are already highly profitable, with strong margins and significant cash flow. They are not relying on future potential to justify their value. They are already generating real earnings today. As shown in this month's chart, revenue, cash flow, and net income are each over 10 times greater for today's leaders compared to the dot-com era. Second is the nature of the investment. In the dot-com era, capital was often chasing ideas instead of tangible infrastructure like today. These are not just concepts. They are extensions of already profitable businesses. That doesn't mean every investment will pay off, but it does mean the foundation is much more grounded. Third is valuations. In 1999, it wasn't unusual to see companies trading at extreme multiples with little or no earnings. Many top companies saw their multiples exceeding 100 times their earnings. Today, expectations are still high, but they are being applied to companies with real profitability. While multiples have risen the past few years, they are still far below dot-com levels. All this does not mean there is an absence of risk. AI adoption and its returns may take longer than expected, and the path forward may be volatile and uncertain at times. However, these key differences help explain why the present may prove different than the past. At TrustBank, we have designed strategies to keep our clients well diversified across markets and asset classes. We believe thoughtful diversification is the key to managing risk and uncovering opportunity through all market cycles. If you would like to explore how this approach can support your goals, we would love to connect with you.